Welcome to CallWiz, where we break down earnings calls. Today, we are on Advanced Micro Devices' second quarter of fiscal 2026, the August 4th call with Lisa Su and Jean Hu. Record quarter, steeper AI trajectory, and a real reset on the multi year story.
Yeah, this one felt different, not just another beat and raise. They are rewriting the size of the opportunity in public.
Exactly. Revenue hit $11.5 billion, dollars, up 50% year over year. Data center is now 58% of the company, up from 42% a year ago. And they guided the September quarter to about 13 billion, up 41% year over year at the midpoint. They now put the data center AI accelerator market at roughly $1.4 trillion dollars by 2030.
The mix shift is the headline. 2 years ago, this still felt like a diversified chip company. Now it is a data center and AI story with everything else riding shotgun.
6 straight quarters of more than 30% year over year growth. Non-GAAP earnings per share up roughly 82% on a comparable basis. And the 2027 language is blunt. Data center segment revenue expected to more than double year over year. That is the step up they want investors to underwrite.
They also said they are tracking materially ahead of the long term model from last November's Analyst Day. Revenue growth substantially above the old greater than 35% target, and earnings per share to significantly exceed the $20 annual target inside the strategic window. That is not subtle.
Let's lock the four numbers that actually matter. First, revenue 11.5 billion versus street at roughly 11.31 billion. Clean beat and up 13% sequentially. Second, non-GAAP gross margin 56%, up over 200 basis points year over year and 80 sequentially on mix. Third, non-GAAP operating income 3.1 billion, 27% margin. Fourth, free cash flow 1.6 billion on 2.4 billion of operating cash, while inventory rose to about 8.5 billion to feed the second half data center ramp. Cash and short-term investments 13.1 billion.
So the scoreboard is green, but the real tell is that earnings grew faster than revenue, and they are still leaning into OPX, $3.4 billion, dollars, up 40%, for AI silicon, systems, and software. They are buying the ramp.
Right. And the comparable basis note matters. Last year's second quarter had roughly 800 million of China MI 308 inventory charges. So they stripped that for the year over year view. Cleaner picture of the underlying business.
Segment split is lopsided in a good way. Data center 6.7 billion, up 107%. Operating income 2.1 billion at 31%. Client and gaming 3.8 billion, up only 6%. Client 3.1 billion, up 23% on record mobile. Gaming 779 million, down 31% on console trough and higher component costs. Embedded 977 million, up 19%, strongest growth in more than 3 years, 40% operating margin.
Embedded is quietly becoming interesting again. Hyperscalers pulling AMD x86 for networking and control plane functions inside the data center. Plus, they are tracking more than 18 billion in new design wins this year.
Gaming is the clear trough. Semi custom is where it is in the console cycle. Client is holding up better than the broader PC market on commercial and AI PC, but they are already flagging softer second half demand from memory and component costs.
Guidance is where the trajectory gets real. Third quarter revenue approximately 13 billion plus or minus 300 million. Midpoint up 41% year over year, about 13% sequential. Gross margin still about 56%. OPX steps to roughly 3.65 billion. They are explicit. Strong double-digit growth in data center and embedded. Client modestly up, gaming down hard.
And the 2027 guideposts are the ones that will move models. Server CPU revenue more than 70% year over year off a much higher base. Data center segment more than double. Lisa later said well over 100%. Second half 2026 server already guided more than 80% year over year.
They also raised the overall company growth language above the old 35% long term target. That is management telling you the prior model is obsolete.
So data center is 58% of revenue now, was 42% a year ago. That is the mix shift investors have been waiting for. EPYC sales grew more than 70% and Instinct more than doubled, driving the segment.
Fifth straight record server CPU quarter. Cloud and enterprise each grew more than 70% year over year. Units and ASPs both up, units more so. Instinct more than doubled on the MI 350 series ramp across labs, clouds, startups, national labs, and sovereign AI.
The question in Q&A was whether the second half is really accelerating. Gene clarified they mean second half versus first half year-over-year growth, not third quarter versus second quarter. Fair, but Stacy Razgon pressed them on the language and they stuck to it.
Server is the sleeper story this quarter. Venice is in production. Zen 6, 2 nanometer, more than 30 SKUs. They claim more than 2 times performance per watt versus leading x86 and up to 3.3 times versus leading ARM. Customer demand stronger than any prior EPYC generation. Cloud providers planning deployments later this year. Every major OEM on track.
Lisa said agentic AI is creating a whole new growth vector: high frequency host nodes, high density agentic servers, plus general purpose. And when they size the $220 billion server CPU total addressable market by 2030, agentic sandboxes are the largest and fastest growing piece, even if they are the smallest today.
Supply is tight right now because the demand spike was unforecasted. They have been adding wafers, backend, substrates all year. That is why they could raise the second half server guide. They expect 2027 supply to be better forecasted and more ample, enough to support the more than 70% growth with potential upside if demand keeps running.
Joe Moore asked directly if they are supply constrained. Answer was yes in 2026, improving in 2027. Chiplet approach helps because they ramp fewer wafers on the leading node.
Helios is the 2027 catalyst. Rack scale, Venice CPUs, MI 450 series GPUs, Pensando networking, Rock C, up to 15% more throughput at same rack power, up to 30% more tokens per dollar. In production, first shipments this quarter, ramp through fourth quarter and into 2027.
Customer roster is the strategy. Multi-generation gigawatt scale with OpenAI and Meta. New Anthropic deal, up to 2 gigawatts of MI 450 in Helios. First gigawatt first half 2027, plus joint engineering with Claude to optimize Instinct and accelerate ROCm. Microsoft expanding Helios at scale on Azure for frontier inference.
Vivek Arya tried to pin gigawatts and revenue per gigawatt. Lisa would not give a clean total gigawatt number, but said they have supply to more than meet the guidance and upside is there. Revenue per gigawatt still double-digit billions. She also told CJ Muse his 30 billion instinct number for 2027 was probably too low. Well over 100% on the whole data center segment does heavy lifting.
Helios demand is tracking ahead of their initial forecast on volumes, not yields. Yields will improve as the ramp matures, which is normal for something this complex. Early quarters will carry some margin noise. They expect it to get better.
On the HBM question, Helios has meaningfully more HBM than competition. Lisa said that is a real TCO advantage on large models. They have multi year memory partner visibility for 2027 allocation, and they can dial the footprint down for medium models if customers want it. So they are not locked into max memory on every SKU.
Software finally gets the inflection language. More than 3 million models run out of the box on AMD. Open source contributions to ROCm up more than tenfold. ROCm.ai lets developers use Claude, Codex, Cursor to port and optimize. They claim more than 2 times training and 3 times inferencing performance versus ROCm 7.
Day_0 support on leading open models, co-optimization with OpenAI, Anthropic, Meta that benefits the whole ecosystem. Plus the Cerebras partnership for fast inference, available in Cerebras Cloud in fourth quarter and into 2027. They are trying to make the stack good enough and open enough that the switching conversation changes.
If ROCm is truly production ready at scale, that changes the competitive conversation. If it is still mostly marketing, the big Helios ramps get harder. That is a watch item.
Outside data center, client is still growing. 3.1 billion, 23%. On commercial Ryzen Pro, up more than 50%, and the AI Halo push. 192 gigabytes unified memory, models up to 300 billion parameters locally. Hugging Face Pro bundled later this year. They expect to outgrow a softer PC market in the second half.
Gaming is the drag and they own it. Embedded is the pleasant surprise. 19% growth, x86 control plane wins, record design win year. Gene even flagged embedded as a gross margin tailwind into 2027 alongside the server mix.
Zoom out. Total high performance and AI compute total addressable market now approaching 2 trillion by 2030, about 40% annually. AI accelerators 1.4 trillion, server CPU 220 billion. AMD says it will grow well above that market. Data center more than doubles in 2027. Long-term revenue growth re-rated above the old 35%, earnings per share to significantly exceed $20.
That is a full model reset. Filings show the trajectory was already steep. Revenue from about 26 billion in 2024 to roughly 35 billion in 2025 and now run rating much higher. Free cash flow has scaled with it. The risk is execution and customer data center readiness, not demand signal.
Lisa said they do not see anything that gives them pause on the targets, but the range depends on how fast capacity and data center build-outs come online. They are working the entire supply chain and the operators in parallel.
5 things to take away. 1. Record quarter, 50% growth, margin and earnings expanding together. 2. Data center is now the company at 58% of revenue. 3. Helios with OpenAI, Meta, Anthropic, Microsoft is the 2027 double. 4. Venice extends server leadership and supply is catching up. 5. The long-term model just got rewritten higher.
What I'm watching next quarter and into 2027, actual Helios shipment and revenue cadence. Third quarter is just the start. Fourth quarter step up, then first quarter another step. Server unit and average selling price trajectory as Venice lands. Gross margin puts and takes as Instinct ramps slightly below corporate average, while server and embedded pull the other way. ROCM adoption proof points with the big labs, and any sign that data center power, shell, or memory allocation slips the timeline.
Also, whether the well over 100% data center language starts to get quantified, and if client can keep outgrowing a cost pressured PC market. Bull case is they execute the ramp and the total addressable market expansion is real. Bear case is concentration risk on a handful of frontier customers, plus early Helios margin and yield noise. The call itself was confident, not reckless.
Grounded in the numbers they printed and the guideposts they gave. This is discussion and analysis for entertainment and education, not financial advice.
Thanks for listening and watching. We will see you in the next video.
See you next time.